Today's topic, I'll try to keep it short and sweet. So that's the idea of it. Just go straight right into it. Physical property as an investment class. What is property as an investment in today's context? The pros and cons of it. Whether you're looking for own stay or investment, how should you be positioning it for yourself? A quick disclaimer. All right, so this is a personal sharing and do not solely rely on this for decision making. Each person got their own situation and circumstances. If you're unsure, feel free to reach out to me. We can discuss further. All right, so straight into it. What is the nature of properties in today's context? All right, the pros and cons. It's illiquid, obviously, because it is even a HDB is 500K. Private residential is easily 1 million and above. All right, even if you have made some paper profit, probably it's not as easy to sell when you compare with the other asset classes like stocks, where you can just sell it on the market that it's ready at any point of time. All right, so definitely it's something that is illiquid. The yield is something a lot of investors wouldn't feel excited about. All right, probably gross yield of around 2.5 to 3.5%. Right, not that fantastic, but it is something decent. So these are two areas probably property is lacking on. So moving forward, you'll see that it is also less volatile. It's a non-speculative product because of the market we are at right now. And it's a product that has less emotions, right? It's not so easy to be very trigger happy. You won't be affected by the kind of daily fluctuations. Some people look at it as a negative because if you want a substantial gain from these property assets, probably you want it to be more speculative. But on the other side of the coin, probably being not so speculative, you'll see a lot of stability in this asset. All right. Okay, it's a safe store of wealth. This is amplified during this pandemic. It's something very interesting. All right. Usually during pandemic and fear, there's something called a flight to safety, right? That means you want something that is of physical and hard asset. That means you can feel it's next to you. That's why gold is going, people are accumulating gold. It is not a yielding asset. That's why people complain about it, but they feel a lot of security holding it. So it involves, because of the stability of the market, somehow Singapore property becomes also a very safe store of wealth in that aspect. In terms of a physical asset, you can see, you can touch, you know it's there. All right. And the next point, even before the pandemic, it has always been a hedge to inflation. I think inflation moving forward, when there's a stronger recovery because of quantitative easing, this is the printing of money. More money will be chasing a certain good, and when there's recovery, the negative thing about quantitative easing is inflation. So of course, property is a natural hedge to it. As such, it becomes a mid to long-term investment. Probably all of these pointers are a bit linked, right? It's not something that you speculate like 1 to 2 years, because it is non-speculative. It is at least a 3 to 8 years kind of investment horizon. And it's a very diversified product, right? In the sense that it's not focused on a certain sector. Residential property per se, you can have people that's working in the tourism industry. You can have people working in the airline industry, which is not doing well. But you also can have people working in the tech industry, which is doing very well. So these people still need a home to stay. So it is a very diversified in the sense that it's a proxy to the country growth, to the strength of the nation. And this pandemic, a lot of people talk about the K-shaped recovery. So as such, you're not just being contained to a particular sector, you're not affected by this side. You're actually as a whole, right? Because it is a proxy to the country. So something interesting there. And lastly, of course, in terms of a forced saving, because usually for property, you won't think about making irrational decisions based on a daily basis as compared to more liquid product. So there's always a pros and cons, right? Being illiquid, actually is a good thing. Because if you see nowadays, if you put in, right, the financing for current situation is 75%. So if you're looking at a 25% down payment, and you probably stay there for 5 to 8 years, you pay down another 15%, maybe you're up by maybe 40 to 50%, meaning to say you stay there for some time, you pay down already, your equity is so much. So if this is a property that's $1 million, after 8 to 10 years, you're easily worth around 500K. Yeah, just going back home to sleep and doing your normal day job. As simple as that. So this is quite comprehensive as to the what is property into this, the nature of property into this context. All right. So moving forward, a table that breaks down the different asset classes. These are the household asset classes that are listed out there. Of course, there are a lot of variants. I mean, if you are very savvy investors, you're probably talking about structured products, gold, alternative, other form of investment. I understand, but this one is more the layman thing. So I talk a lot about physical property already. If we move on to cash, you will see that it's also very liquid. But in terms of the risk and rewards, of course, is very linked, right? The higher the risk, the higher the reward. The lower the risk, usually the lower the reward. So it's the yield, it's not as good. So it's actually a good comparison with property because it's generally a very safe asset. Okay, fixed income, as the name suggests, it gives you a fixed income for whatever certain period of time. And it's good to know that in these categories, there are different kinds of fixed income, right? Usually you're talking about bonds. You got your corporate bond, and you also got your country bond, like SG bond and government bond, right? Usually your corporate bond, there's also the AAA rating, the junk rating, and it determines the risk and reward for this. It's rather, it can vary, I put it this way, but generally when you're talking about fixed income as compared to stocks, it is more stable. It's more liquid. It also can be traded. The reward, of course, is a bit lesser because it's only a fixed sum. Stocks, highly liquid, you can be traded. Same, I put it together with REITs because REITs is also traded on the stock market. All right. The risk and reward is, of course, higher. Volatility is high. It's very reflective of the market sentiments at any point of time. Diversification will be a bit low because if you're looking at a particular stock, it's only investing in that stock. Later, I'll talk a bit more on that. And the last point will be endowment, which is also a good comparison to property. And endowment have also a very long-term investment horizon, and you're looking at a decent kind of rewards and generally very low risk. All right. So let's talk about a little bit more on this property versus endowment. Okay, you can see that it is a very, very similar product, but generally there is a lot of differences inside them, and you can see which one is better once I break it down for you. Okay, they are similar in the sense that they are long-term investment product, probably the same kind of investment horizon, 20 to 30 years, right? 20, 30 years in terms of when you are starting that and when it's maturing. And in terms of property, it's more of the loan tenure. That's why it's similar to that aspect. The difference comes here, right, in terms of leverage. So, property, the essence of property is that there's some form of leverage in there. And this is not just any form of leverage. It is a very safe leverage that even HDB purchasers have this kind of leverage loan involved. So when you have this kind of leverage, your returns are generally a bit better, correct? So safe to say, if I give you a simple illustration, if you buy a property that's $1 million, correct? And there's a cash down of 25, cash CPF down of 25%. So your return, it's your investment is 250K. Say it goes up to 1.2 million, and there's a return of 200K. And you probably this is on the first day that you bought it, and you hold it for some time. Maybe you put in another 50K already. And let's say, to be fair, I mean, there's some costs involved, interest costs and transactional costs, agent fee, things like that. Let's say your return is only 150K. Okay, so if you look at this directly, right, your 150K, it's over a cash investment of 300K, which gives you a return of 50%. And if you hold that for 5 years, per year return, it's probably 10%, minus even more cost being more conservative. Let's say you look at thereabouts of 8%. I think this is a fairly decent return of investment or cash on cash return, right? As compared to endowment, it leads to this point, which is at any point of time, it is of the certain cash value that has been accumulated. And usually if you don't hold it to maturity, probably your cash value and the bonus will be much lesser. But property, although it's a 30 years loan, if you sell it after 5 years, it is still reflective of the property value at that point of time. All right. So who is paying for it? That is a very good question, especially if you're holding a second property for investment. As compared to endowment, which you're paying on an annual or even a monthly basis, property is paid by the tenant. So even you can tell me in today's context, right, Xavier, hey, the cash flow is not there. There's no positive cash flow. But it's okay, right? Even if you're paying, if you need to put in maybe $200 per month, and over the 30 years, you put in maybe 10% of the property value, but ultimately 90% of it is being paid by someone else. I think that's pretty awesome. All right. Transparency in the sense that if you look about endowment, probably you have to choose the funds that you want to invest in, and you don't know whether it's a funds of funds, the layer of costs involved, and you don't really spend a lot of time looking at the fund fact sheet. You don't know what they invested on. You have to spend a lot of time in that sense. So the terms of transparency is a bit harder to control, but physical property, you see day in and day out. All right, diversification, which I talked about in terms of property being just a very general diversified asset class. Okay, so property versus REITs. I think this is a common questions that investors will ask, right? If I buy a property, it's quite similar to a REITs because it's an exposure to the property sector. But we have to understand what is REITs and also what is the REITs investing in. That's very important. REITs, in one sense, it's definitely more volatile because it is very reflective of the stock market sentiments. I mean, the pandemic itself, you see, if you monitor stock market, I think you know that a lot of REITs are trading below their price since 1 year ago, as low as 30 to 40%, right? But of course, REITs have a better yield. Some conservative, stronger REITs are doing maybe 4 to 5% on a stable time. Right now, of course, it's a bit lesser. But if let's say it's a risk that it's taking on a little bit more risk, then I think it's as high as 8% if I'm not wrong. So in terms of view, definitely I'll be looking at REITs. But a point to note also, it's REITs, unless you're buying the index, REITs, it's not as diversified and it carries a very a high risk in that aspect, right? Because there's so many different kinds of REITs. If you are looking at the hospitality sector, you've got your Escort, you've got your Far East Hospitality. If you are looking at the malls, you've got your CapitaLand malls, you've got your Fraser Center Point. If you're looking at the office sectors, you've got your Capital Commercial. You're looking at industrial, you've got your Ascendus REITs, correct? And the one that is doing very well right now would be the data centers. You've got your Keppel DC, if I'm not wrong. So I think you have to be very sure on what you're investing in. All right. And it's also very interesting in that sense. Let's say if you are very fully invested into residential property and you want a little bit of exposure into commercial, it probably is a way to go also for REITs, right? Because you don't need to pay a few $1 million to buy an office space, a strata office space. You can tap on the expertise of of a very good manager that's managing this space, at whichever sector. So I would say in general, if you want exposure to the commercial industrial side, probably REITs have better exposure to that. But in terms of residential development, things like that, if you're probably looking at the mother stocks like the CapitaLand, the Keppel, the SPH, and this kind is a totally different topic because probably they are not only invested in the development side of things, right? So REITs probably also lesser leverage. You can take leverage, but it's more risky in that sense. Property, as mentioned, leverage is just part of it. Okay, this is the STI Index. I think it summarized everything about the stock market in Singapore. Where we are right now over here, it's very sad because it's kind of like the same point since 2006. And if you look back, and from then until now, you can see that's being range bound and trading sideways. And this is already the index. It's not surprising to see what is happening right now. But because if you look at the component stocks, for example, the badly hit one will be SIA, you got your sets with the right issues and everything. Wow, I don't know. It will take a very long while to recover. And ultimately, people say they ended up to be long-term investors, right? And then, unless you're in the bank stocks, if not, I think others are also quite gloomy, like the SIA sets, you got your SPH that's not doing well, your Singtel is neither here nor there, Sembcorp. I'm in similar boat also. I got a couple of this, and they're really not doing that well. So if you compare something like that to this residential price index, this will be the private non-landed residential price index. You realize that it's also trading a bit sideways, but instead it is also trading in a range. But instead of being sideways, it is actually trending upwards in general. So my point over here is, let's say if you're very unlucky, right? Very unlucky, your timing is bad, or you bought the wrong unit. You paid the most expensive price at the just at the peak before the global financial crisis took place. All you have to do is probably just hold until this point of time, probably 5 years. It would have already recovered. All right. So this is the general trend. Of course, it is representative of the entire market. If you look at it in detail, I split it up into 3 different zones. These 3 are the commonly used zone, right? Your CCR. Oops, this one is not here, so this CCR. Then you got your RCR and your OCR. CCR will be the center core region, that will be the light blue. Your rest of core RCR will be the orange, and your outside core will be the outskirts of Singapore, that will be your purple. So in general, you realize that the drop is much lesser as compared to the global financial crisis. And this is explained, of course, it's a huge topic alone about the market trends and everything, which I'm not going to cover today. But what this graph ascertains is, property is a very stable asset. Because we are in one of the worst crises, but the drop, even if you split it up, it is definitely much better than compared to the 2008 time. Strangely enough, in the OCR region, it even registered some amount of growth. All right, but this is very good sign, you know. If you have this kind of demand, it shows that there's underlying organic demand, right? And this is healthy sign. You don't want to be very dependent on foreigners, investors, speculators that we are buying. You want to be dependent on the local core of people that are buying, because you know that this forms the majority of the purchaser. So if this is doing well, it shows that it's actually quite healthy. The drop, definitely there's jump drop, and one of the biggest crises of our time. But it's also good to know that these crises it's a little bit different from this. Let me talk a little bit about this. The global financial crisis, there's more of a credit issue, right? But right now, I would say that although there is this pandemic, credit is still okay. And credit is the life, is the blood of the operations of the economy. as long as they keep it pumping with QE and to keep borrowing accessible and wait for the recovery to happen, I guess it should be good that way. Okay, so we know about this the cons of property. Let's look at that and I thought of some ideas to address this negative things about the property, which is it being very illiquid and also having a lackluster yield, right? Yeah. All right. So if it's so illiquid, we probably want to be very selective to find a good unit with a greater with a more predictable exit strategy. Right? No one can read what will happen in the future. But you know, a lot of properties are sold on a future growth perspective, the transformation, the things like that, and the future pricing. But what we can do over here is to choose a good unit with better clarity, certainty, and likelihood that you can exit at a certain price to solve this illiquidity. Am I right? So the next point is also about diversification. A simple illustration and question that you should ask yourself, let's say if you have around probably 2.8 million to 3 million combined income, would you buy one landed, or would you buy two separate condo units under two different names, obviously? No, there's really nothing wrong. I think they are both very good asset classes for landed or condo. But if you know that property, the nature of property is illiquid, you probably don't want to put all your eggs in one basket. Of course, it depends on your situation. It depends on your net worth, your financial ability, things like that. This is just a general statement. You want to have two so that at least it's at probably two different locations, that you either one you can sell if one is not doing well, things like that, right? To solve this illiquid problem. The other thing is about opportunity cost. If you know that it's illiquid and hard to sell, you probably want to have a thorough review of your property portfolio every 2 to 3 years, right? To be sure that it is something that's worth holding. You don't want to be holding on to something that's no good, right? You want to know like which one out there, you call it the we call it the review of the portfolio, and in terms of changing your portfolio, which one is better with better gain, which one you will know that it will stagnate. If your existing one will stagnate. So this is something to think about. All right. And yield per se, like I mentioned, a gross yield of 2.5 to 3.5% probably is not that exciting, but it forms a base. I think property, no matter what, it is a function of the price. It can always be rented out. But if we know that the yield it's not something that that is good, we probably want to focus more on capital appreciation. We focus on the strength of it. All right, because of the leverage involved, about the higher ROI. Okay, if you've got any questions, feel free to ask me. I mean, you also can separately PM me, and I will definitely discuss more in depth with you based on your current situation. So this last part would be what it means for you at different cycle of your life, different part of your life, right? I basically just split it into three different life stages. Sorry. So it's something that's very generic. Of course, not everybody will have this particular plan. It really depends on yourself also. So one is up 35 years old. The next one will be 35 to 55 years old. And the last one will be above 55 years old. Okay, let's look at the one that is up to 35 years old. Okay, up to 35 years old, probably you will realize that property equity represents almost your entire net worth, right? Even if it's HDB, EC, or even condo. And if you factor in the loan involved, you realize that you are net debt. So just by these 2 points itself, you want to be taking property purchase very seriously, even especially if it's your first one, it represents almost all your net worth. All right. You want to be looking more from the value perspective of things rather than focusing on own stay. Of course, as the first property, most of us are buying for own stay. What I'm saying over here is because of what is happening, the situation, you want to focus more on the value side of things. Put that as the priority. All right. Think about opportunity cost also. Because of the fact in the previous slide I talked about it being very illiquid. At this age, an example would be, let's say, buying into a certain property with some restrictions, like a government property, whether it's an EC or a HDB that has a 5 years MOP together with a building phase of 3 years, which now delay up to 4 years because of COVID. So it's like an 8 to 10 years period, right, that you are stuck in this. Depending on situation, I mean, if your income is good, if you know the trajectory of your job, it's very good. You both of you will be working. You have a lot of clarity on that aspect. Since it is so illiquid, you probably don't want to lock yourself in for 8 to 10 years, right? So that's something to think about, because I think even a few of my clients and friends are in this situation whereby they're thinking of getting out fast. All right. And you're at this age where you have a little bit more ability to take on risks. You are younger, you have a smaller family. Probably you're not in that stage where you need to take care of your parents yet. Your health is generally quite okay at this age, so you can take on more risks. In that aspect, we'll be having a longer loan tenure. Time is something that we cannot control and we cannot buy. So when we are a bit younger, age is on our side. So a longer loan tenure, we can take a longer loan tenure with a bit more risk and focus. Therefore, the summary will be focused a little bit more on having an investment point of view. It may not be the home that you want to stay 100%, your dream home. Some amount of being uncomfortable is needed in that sense, and then focus more on capital appreciation at this stage. Okay, so when you're at the next stage, the in-between, right, 35 to 55, at this point, I think it is a lot of room to play with because it is a wide gap and you've got different aspirations depending on your work situation, your family situations. Is it a dual income, or has one stopped working to take care of the kids? Generally, people have already, at this point of time, they have already accumulated some amount of wealth. They are looking to maintain. Some of them probably want to take on lesser risks, focus more on enjoyment. Totally agree. You probably, if they can make it, get landed, spend a bit more money on renovation. At the same time, if you have already a portfolio of properties, you want to be reviewing your properties as mentioned before, and looking at restructuring or switching. In the sense that just now I mentioned about which one is doing good, which one is doing no good. Have a critical look at it, have someone to look at it. That's very important. And probably look at diversifying into commercial, industrial, or even overseas properties. So overall, I'll say we are kind of equilibrium, really depending on the situation. Okay. Now, when you're 55 and above, most probably you are more relaxing in your life already, right? You want a little bit more liquidity. Why? Because you're starting to plan for retirement. If you have not, maybe in the next few years, 60 plus, you're planning for retirement. Health may be coming as a concern to you if you feel that you need the emergency funds to set aside. Probably student education, because they're at the age whereby they are in their tertiary level, they're exploring and you want to fund that, right? Tertiary, your kids' tertiary level, ultimately you need more liquidity. And you want to focus more on you because you are looking for a passive income stream when you're not working, right? So this is something to think about. You generally, as mentioned, want to reduce risk. So in terms of your portfolio wise, depending on situation, again, you may just do nothing, right? The advice might be just to be status quo. Might want to downsize if you want to cash out, get more liquidity, and probably think a lot about legacy. In what do I mean by that is because you're at the age where you cannot take loan, you're retiring, you don't have an income. What are ways that you can help your kids or even your grandkids buy a property? You're looking into different strategies like buying in trust, or just like cashing out, right? Getting the liquidity to help them for their down payment. All right, so these are the things that is for 55 years and above. And great, I think I'm on track. I just completed everything in 30 minutes. I hope this is helpful for you. Just let me see if there's any questions. Yeah, so I don't think there's any questions as of now. If you have, again, please feel free to reach out to me. And I'll just end off with this last slides. Next week, I'll be sharing a bit about some practical tips. There's a lot of sharing that's been done on the purchase side of things. So this will be the on-the-ground practical tips on how to be a very, very good landlord, right? Setting up yourself for success right from the start, finding a good tenant, have a worry-free tenancy, and probably some case studies. All right, so I want to thank you again for being here. And if you're going to watch the recorded version, thanks for your time and attention. I hope I value added a bit in terms of your education for the property side of things. Again, please feel free to reach out to me if you have any questions and that's pertaining more to your situation. All right, thank you. Great, I'm on time, on track. I wish you a great week ahead. All right, thank you and good night. See ya.